Hello viewers, in this video we'll be going over the S&P 500 ETF ticker symbol SPY. In this video we'll be going over day-by-day probability, how we found the models, and we'll go over where the S&P 500 will head to in the next coming days. So back to the technical analysis. Today we made all-time highs of $327.46 and we are up 5 basis points. On the 1 hour chart, we are heading toward negative MACD. We were touching overbought RSI overnight. And as for the 4 hour chart, we start to see a divergence shaping on the 4 hour MACD. We are still close to overbought RSI. We are below the 9 moving average on the 4 hour chart. We'll see if we manage to close above it. If not, we may head down lower and find support around the 18 moving average on the 4 hour chart. So back to the daily chart, I do see we made a gap up overnight between January 8th and January 9th. So I do see that filling up soon. And the next support that I see is the 9-day moving average, which is this blue line, which coincides with price concentration around past resistance. And since we're above resistance, that now acts as our immediate support, which is around a price of $323.75. So if we were to move down lower, that price movement is roughly around 1% to the downside. So let's head to the day-by-day probability model. So if we move up here, again, this forecast model is now available in the link below, so do check it out. So what we have here as the day progresses, we have a slight high concentration between the 1 standard deviation lower and 1 standard deviation higher. So as day progresses, we have a slight favor to the downside on the 7th day. We have 53% as well as 13% on extreme case where the S&P 500 fall between 4 to 2% down. If we look to the other side, we do not see that case here. No case of 2 to 4% up. There's a slight chance we may climb a little bit higher with a 33% of climbing 0 to 2% in the next coming days. So take that into consideration. So let's head to the day-by-day forecast model on here. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, and below is the trend that I believe is the best match. This trend dates back to January 9th, 2012 to April 4th, 2012. So let me point out why these two charts are similar. So what we have in the current trend, we see average above the middle Bollinger Band for several days at this instance. And next we see a dip below the middle Bollinger Band right in the middle of the trend. Next we see another trend averaging above the middle Bollinger Band as well. So we see those 3 points. So in the trend in question, we start to see a similar pattern at the start. So we average above the middle Bollinger Band. Next, we see take a slight dip below the middle Bollinger Band. Then once more, right towards the end, we see it average above the middle Bollinger Band, right towards the end. So what we have is 1, 2, 3 points. We also have 1, 2, 3 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was 2012, January, let's try and find it. So it's 2012, January 9th to April 4th. So back then the S&P 500 was down roughly around 2.1%. So 2.1% in next coming days. So let's head to the day-by-day probability model. So 2.1%, that slightly coincides with this instance where we fall into the 53% chance of falling that percent range and slightly around this standard deviation, 13%. So I do see the S&P 500 may give up some gains for the moment and head down lower in next coming days. So that is it. If you enjoy this content, feel free to like, comment, subscribe, and thank you for watching.